Hi everyone. It's we will begin this session dedicated to crypto vault. I'm very happy to introduce you this topic with Emil Owens, whom which I'm co-hosting this event. And basically, we were interested into the notion of crypto vault because it's a catch-all term. It covers probably a wide variety of situations from an external perspective. However, it's a very specific topic, and we wanted to have some specialists giving you the best view of this problematic and some kind of a highlight from their industry on how they use and what is actually a crypto vault. I guess it's one of the most Swiss topics that we could choose, especially because the two words, first, the word crypto, that relates directly to the secrecy, to the privacy, and that is actually dear to us in Switzerland. And the name Vault is also a symbol of Switzerland. So I'm pretty much very happy that we have come with the most Swiss topic from the CVA that we could have found. As I said, the objective today is to really understand what is the crypto vault, what is a crypto vault, and we're going to take three main approaches. We're going to have some speaker coming from the business side of this industry, presenting us the opportunities and the governance of such systems. We will have some authors that have a technical approach that will actually explain us what is technically a crypto vault. And we'll have, of course, the legal aspects that will be dealt with. The idea is to keep it short, to keep it qualitative, and we'll do like that. We'll have basically 4 presentations. The first presentation will be held by Adrian Treccani from Metaco, and he's going to talk about the technical standards. It will be a 10 minutes presentation, something around that. Then we'll have some Q&A session where you will be able to participate. When you look at your chat, you have a Q&R. You have a Q&R wording on your band where you can ask the question, and I will ask those questions for you. So in between all presentation, you will have the possibility to ask the speakers 1 or 2 questions. So the first presentation, as I said, would be presented by Adrian Treccani from Metaco. The second will be held by Markus Perdrizat from the Swiss Crypto Vault, and he's going to talk about the business opportunity that relies in this industry. The third presentation will be held by Vincent Debast. He's a specialist at Ledger, and who will talk about the governance of a vault and the UX UI experience. And the last presentation will be held by Tina Balzli at PwC Legal, and she's going to talk about the regulatory aspects of the custody of blockchain-based assets, basically. And this will be the first part of our reunion today, and the second part will be dedicated to a panel where Amy will host the 4 panelists and will ask them her question and have hopefully a very lively debate where you will be also probably able to participate. So don't forget, type in your question, and without further delay, I'll ask Adrian Treccani to take the lead, to share his screen, so we can begin the presentation. Thank you.
Thank you, Gabriel. It's a pleasure to start with the first presentation at this great event. The objective for this 10 minutes is to cover some of the main topics in crypto custody. What are the latest trends? What are the main challenges and how we've got there? All the progress we've made in the last 10 years. I would like to start with a very quick review over the last 12 years. Bitcoin was originally invented and created to entirely bypass any trusted custodian like a bank. In 2008, Satoshi Nakamoto introduces Bitcoin, and you can essentially use Bitcoin from your mobile phone, from a USB stick, or directly on an application on your computer. Many things have happened since then, through Bitcoin being used for criminal activities, but then being much more legitimate, to then other cryptocurrencies popping up. And we have, I think, after a few bubbles and corrections, reached a point where we've reached this plateau where institutions are actually getting in and finding now important business cases where they can act as custodians, as tokenizers, essentially take a first-class role in this economy. And the main challenge that we've observed in the last 5 years, I would say, with these companies offering services is that it re-centralizes the risk. Such companies have to manage keys, they have to essentially be liable for the assets of their clients. And we've tried everything we could in this ecosystem to minimize the trust that we need to have in these intermediaries or third parties. And as you know, the main trust that you need to have when dealing with such a company is around the way a custodian manages its keys. As soon as we speak about cryptocurrencies or tokens or digital assets in general, everything is secured with the notion of secret key. A secret key is like a long password, and this password is the unique access to your cryptocurrencies and your digital assets. So if lost or stolen, so are the assets, and it is critical that it is therefore maintained with high level of confidentiality, but also that it is properly backed up. As you can see here, there have been a lot of examples of both individuals and companies losing their keys, or at least losing some of their assets. It is estimated that 28% of all Bitcoins have been lost or stolen to some degree. And this is only speaking about Bitcoin. If you start speaking about other cryptocurrencies or DeFi or altcoins, the number would be very high too. This has not really improved in the last few years. Some of the largest exchanges have been subject to technical issues, to hacks, or to frauds, internal frauds being one of the important points. And therefore, we see more and more demand coming from regulated and trusted banks to offer high quality custody services. One of the first questions that you may ask yourself when you invested in cryptocurrencies for the first time was, where do I put my key? And the first sort of decision factor is typically to decide, well, am I going to store it on a connected device that we call a hot wallet, which could be on the hard drive of your computer, or which could be in a database in the case of a custodian, versus what is called an air-gapped or cold wallet, where the key is completely isolated from the network, and there is a high guarantee that the only way to access this key is to actually physically access the key store, which can be a piece of paper, which can be a box, which can be special hardware. Now, the current practice today on the market is for custodians to put as much as they can in cold storage. And typically exchanges would put 95+% of their assets under management in cold storage, and to still keep part of the assets in a hot storage. Reason being that obviously you have this trade-off between agility and security, and it is very hard to maintain agility and be able to transact at a high pace if you have your assets secured offline in a cold storage. Now, this is not enough, as you can imagine. The question is, first of all, where do you put these keys? Even if they are cold or hot, where do you put these keys? And in the last 20 years, if not more than that, the standard practice has been to rely on so-called hardware security modules. An HSM, or hardware security module, is a special piece of hardware that provides a high level of guarantee that the keys are confidential and they cannot be extracted out of the hardware without any kind of physical tampering to the box. In fact, some of these hardware modules even guarantee that with physical access to them, they still will not leak the key material that they've been configured with. HSM have been very well known in banking for many years, and this has been also the basis of most crypto custodians infrastructures. However, in the last couple of years, a field of cryptography, which also is known for quite a long time, but which is more recent in the context of digital assets, has appeared as being an interesting new alternative in managing keys. Multi-party computation, or MPC, is the idea that rather than trusting hardware, a more efficient way, again, this is debated, but a more efficient way could be to have the key split in multiple fragments, and each of these fragments independently would be useless, but together would be able to generate what is called a signature to authorize a transaction. The security principle here is that you don't trust this single point of failure that is the hardware. You don't have to trust a hardware manufacturer. Here you split the key and you assume that breaking these different keys fragments at the same time is extremely improbable. And we've seen multiple companies moving to MPC, and at least for the context of hot wallets, leveraging hardware-less, or let's say without special hardware infrastructure to maintain their keys. The advantage of MPC arguably is that you don't have dependency on these low-level hardware architectures. You can deploy this in the clouds, and you can decentralize the risk by having multiple parties, as its name indicates, maintaining the whole key and never re-centralizing the whole key in a single place. The disadvantage, I would argue, and of course it is yet again something that is debated, is there are multiple weak points sometimes in terms of rotating the keys, regenerating new keys, and in particular it is, because these key fragments are stored directly in the cloud generally or in a virtual machine, the security, the attack surface around each of these fragments may be much wider than what you generally have with special hardware. But at the same time, we see that even the largest companies on the market, whether it's Coinbase, have moved into providing some level of MPC technology for their hot wallets. So it's becoming more and more relevant. Now, whatever key store the custodian is leveraging, a key store, as its name suggests, is nothing more than a way to store the keys and potentially use them to sign a transaction that then is executed and broadcast on the chain. But the weak point quite often is not the key itself. If you think about an HSM, this hardware box, it is nothing more than a stupid signing box. Stupid in the sense that it exposes an API, it exposes an entry point, and you can use this entry point to ask the box to sign arbitrary things. And even if you're not able to extract the key, if this API is compromised, potentially the attacker can ask the box to sign any Bitcoin or Ether or a token transaction whatsoever. So the weak point of such a system quite often is not the key itself. If you do have a strong key store, whether it's an HSM or an MPC technology, the weak point quite often is around what governance layer you have put around your system. And if you think about the Quadriga hack that happened a couple of years ago, for those of you familiar, it is this Canadian exchange where the founder was the only person to know the passwords to the main wallets of the company. And allegedly, he died at some point, and therefore they could not recover the funds of the wallets because he was the only one to know the password and therefore to be able to use the funds. It was then demonstrated to some degree that he probably didn't die. He probably actually used the funds way before he announced his death, or his wife announced his death. And the intuition here is that he probably used the funds for himself to get richer himself way before, just because he was this single point of trust. And this really shows how important it is that the trust around the using the system itself is also distributed. There is no single point of trust. You have a strict protocol around who can do what. Typically for large transactions, it would involve more people in the company to authorize the transfer. And this is something that banks know very well, that they've been doing for many years, way before cryptocurrencies were institutionalized. What we see today is that these same frameworks that have been known by banks for a long time are now appearing for cryptocurrencies and becoming best practices. And I would say required practices because of all of the risks we've seen in the last few years. Now, the main challenge we start seeing on the market is it's one thing to be able to store and occasionally process a transfer. But what was maybe 5 years ago an objective to store securely has moved very much into interacting with assets. We started, we just need to store Bitcoins and we don't want to lose them. But today, it's more than just storing Bitcoins. You want to be able to pay. You want to be able to move Libra. You want to be able to stake potentially. And the more use cases we start seeing appearing with distributed ledgers, in particular related to tokenization, staking, or decentralized finance. All of these new protocols, which for some of them are sources of potential revenues, you can generate a yield with staking, for instance, they require some dynamic interaction. They are not so easy to deal with if you only have a cold storage. So what we see more and more is a need for agility. And this agility, you don't get it with a cold storage. So I think a big topic today, and some of my colleagues are going to jump on this topic also, is going to be to pretty much give a solution to how we can maintain a high level of security as a custodian, as a bank, as a regulated company providing digital asset services, secure services which at the same time do not isolate the clients from all of these incredible opportunities which are popping up on the market today. And so I will conclude on this. Metaco, we are a Swiss company based in Lausanne. We've been now for almost 5 years on the market, providing enterprise solutions for the management of digital assets. Most of the topics that are presented today are things that we know very well how to do. We have solutions for hot cold storage, for the strict governance layer, for hardware and MPC, and obviously with applications to tokenization, to DeFi, and to staking. So thank you for your attention.
Thank you, Adrian, for this presentation. There are no questions. I'll just remember the audience that they can always ask questions, but I have one for you. I wanted to know if you could tell us in 1 minute whether there were lots of standardization with regard to the custody of assets, and whether there were a lot of difference maybe that is made with regard to the asset that is actually in custodial.
I think the market is moving in multiple countries, and it's always hard to answer it with a generic response to that question, because it is completely different in Germany than it is in Switzerland, that it is in Singapore, and obviously in the US. So I would say that yes, standards, best practices are appearing pretty much everywhere. But we also see that regulators and advisors sometimes are taking very hard decisions on what the best practice should be. If you think about Singapore or some countries in Southeast Asia in particular, they have imposed that most of the assets are in cold storage. And although I would argue that maybe there is some goods to it, it also puts the regulator in a position where the regulator takes a very hard decision on what is the right approach to deal with security. And I think that we've seen that in other fields, but it is still quite interesting to see how the market is moving, where best practices become potentially mandatory practices.
Thank you for this answer. I'll now give the lead to Markus, and he will talk to us about the business opportunity. Markus, you have the lead. You can begin talking.
Thank you, Gabriel, and good afternoon, ladies and gentlemen. My name is Markus Perdrizat, and I'm the CEO of Swiss Crypto Vault and head custody at Bitcoin Swiss. Before joining Bitcoin Swiss, I led PwC's Blockchain Competence Center for the last 4 years, and I'm also a co-chair of the Crypto Valley Association's Cybersecurity Working Group. By the way, if you don't see a presentation, then that's because there is none. We'll have to take this face to face, as in the past. First, let's take a step back. To understand what is a crypto vault, we need to understand what is custody. Custody is when you give me something and I keep it for you until you request it back. Like this. You give me a hat, I'll keep it for you until you request it back, and then I give it back to you. But custody in crypto is different. Look at this. It's a vault, a crypto vault. It's a Bitbox 2, a Swiss product, by the way. In crypto custody, you don't give me anything, but you do send assets into an address that's associated with a private key that is managed in this device. And I provide you with a system that will allow you to get it back when you need it. So you heard from Adrian that we do store something in the vault, and that's obviously the private key. And we have an elaborate rule set around who can access it. That's the secure rules engine. And that sounds very similar to safe deposit boxes, a traditional bank business, and also a Swiss specialty. And it is indeed similar. The Safe Company operates a system consisting of a process and technical security measures. And you can bring or send your stuff into it, and you can extract it again following a defined protocol, the approval rules. So let's look at the safe deposit box. The bank operates the vault, the safe, according to specific procedure. You as their client, you're able to enter the room, gain access to the safe, and then you have the key to the box. And only you have the key, nobody else. And that way, you can put stuff into the vault and remove it again. That is actually similar in crypto custody and crypto vaults. And for what it's worth, in a proper third-party custody system, don't accept a device like this. Because when I hold it, I have access to its transactions, and I'm potentially able to extract the private key. You don't want to have that in a proper crypto vault solution. A proper vault system is locking down access to transactions and private keys such that nobody of the vault operators is ever able to access your transactions or the private key, and only authorized clients are able to initiate and approve transactions. This is just like with safe deposit boxes. There is a huge tradition of safe asset custody in Switzerland, going back hundreds of years. And that's why the crypto custody business is also big in Switzerland. It's a trust business. You need to trust the vault operator that they won't lose the private keys and that they won't be able to run away with your assets. Obviously, one way to reduce the trust and bring in transparency is audits and control reports. That just as a side notice. Switzerland has a long tradition and a very good reputation in that trust business. And that is one of the key value propositions also for crypto vault businesses in Switzerland. Now, we are all here because we believe in the power of decentralization and the need for digital and programmable money. We're here because we believe there will be an explosion of digital assets and everything will become digital. That is the primary business opportunity for crypto vaults. People need to store their digital assets. Companies need to store their digital assets. And even digital autonomous organizations need to store their digital assets. It's a huge market. It's much bigger than everything that people are storing in bank vaults today. Having a crypto vault is required infrastructure to do any kind of business in crypto and digital assets. As more and more assets are digitalized, they will need to be stored in digital vaults. As more and more companies digitalize their business models, they will need to store their assets in a digital vault. But you know what? The ability to store digital assets is not the end of all means. You also need to be able to buy and sell these digital assets, to transfer them. So the brokerage and the access to liquidity is just as important to digital assets as is custody. Brokerage is also part of a base crypto infrastructure. Once you can buy, sell, and hold crypto assets, then you start to become a full citizen in the decentralized world. And if you are not already there today, then now is the time to invest in building this infrastructure for the digital age. Banks, institutions, funds, and all kinds of startups are now starting to build on digital assets. And the first step they need to take is to build the infrastructure for digital assets. We've seen startups building on blockchain for the last 12 years. And we see a massive influx of traditional financial institutions now. They start to enter the crypto assets and tokenization space. Heck, even Debast in Singapore and a lot of Swiss cantonal banks are working on crypto asset projects now. All of them are starting by building the infrastructure first, to build the custody and payments and liquidity rails. That is the increasing business opportunity for custody providers, vaults, and crypto brokers. Now, for the longest time, being able to buy and hold was all it took to be happy in crypto. Prices increased, and by virtue of hodling, people got very rich. However, luckily, that is no longer the case. Now, the smart money is working to earn more money. Financial products are living on the blockchain. This is staking. This is decentralized lending, yield farming. This is Aave, Maker, and all the other DeFi protocols that are out there. And this is great. Finally, my digital crypto assets are earning money while I sleep, just the same way as in traditional banking. But it's a challenge for us in the vault business, because it requires a smart vault. What is a smart vault? It's one that allows the smart money to work while it's stored in a high security vault. For the longest time, crypto vaults were happy to just provide the secure holding of crypto assets. That is the HODL use case. And this is changing. Bitcoin Swiss Vault, provided by Swiss Crypto Vault, was the first fully audited custody system to offer staking earlier this year, and will continue on the path of the smart vault. Vaults are not only infrastructure. Vaults need to be smart infrastructure. I think we can fairly say that as a sector, we have solved the challenges of securing large amount of crypto assets. But what we have not solved across the board yet is to provide a system that unlocks the full potential of smart money while keeping it in the high security of a crypto vault. The challenge of smart infrastructure. The speed of innovation in DeFi is at odds with the requirements for having a stable and highly secure vault as a base infrastructure. And we are working hard to unlock that potential for our smart clients, because at Bitcoin Swiss, we are committed to building the smart infrastructure for the decentralized financial system. And we're not alone in this. We're in this together. That's why we're all here as members of the Crypto Valley Association. And with that, I'd like to hand over to Gabriel for questions. Thank you.
Thank you, Markus. Thank you for your presentation. I especially like the part where you talk about dematerializing the Bitcoin Swiss cap. It really talked to me. With regard to the chat, people are still very shy, but there is one question that someone wants to ask you. Basically, when you talk about custodials, it means that there is no seed words that is made. What do you do in case there is a legacy or a heredity case with those assets?
As a custodian, we have a relationship with our client that is based in traditional law. And if our client disappears and leaves their heirs, just as with any normal relationship, their heirs will inherit what is stored in our vault. Obviously, they will need to know the access codes and access permissions of the person who set up the initial account.
Mm-hmm. Okay. So I hope this answered the question. I have a small other question coming up. We have AML and a question coming up, but we'll deal with that with Tina. But with regard to the market that it represents, does it represent a big market with regard to the institutional actors, or is it a retail market? Maybe you heard of this way the Winklevoss brothers used to store their assets, like having one cryptographic key in a safe in a few places around the world. I mean, is it a retail market really, or do you need to have billions before you invest in a crypto vault?
Operating a crypto vault comes with a cost, and we need to recover that cost from our clients as any other custody operator. And frequently, what vault operators charge is a small percentage of the assets under management on a yearly basis. We say that it's worth having a proper enterprise-ready and high-security vault for your assets when you don't want to worry about how to store your assets, and when they are a large enough amount of value that you would worry about it if you didn't store it in a vault. And on a numbers perspective, that starts based on our fees, starts about at 100,000 Swiss francs, where we recommend clients submit their assets into the Bitcoin Swiss Vault.
Okay, thank you. In order to keep it on time, I will now ask Vincent Debast, who works for Ledger, who also develops a vault solution, to take the lead and talk about his presentation and what he wants to share with us today. Don't hesitate to keep writing your questions, and I will try to make them fit within the schedule we have.
Thank you, Gabriel. Normally, you should all see my screen, so please shout if it's not the case. Thank you very much for having me today. Thank you to the Crypto Valley Association. My name is Vincent Debast. I'm product manager at Ledger based in Paris. Today, I want to speak about the Ledger Vault solution. Our Ledger Vault solution is our solution for institutional customers who want to adopt crypto assets. It's live since September 2018. What makes us different is that we are very strong believers in hardware security, like my previous colleagues from the industry. And we take that to an extreme. We use hardware security module, but we also use personal security device, which are put in the hands of every user working on the platform. As you know, Ledger is very present in the hardware space where we sell our hardware wallets, and Ledger Vault is the solution which adds upon the security, the governance layer that you need as a financial institution. I want to emphasize that we are a SaaS provider. We provide the technology. We are not a custodian. So our customers are financial institutions, either custodians or asset managers who want to secure the cryptocurrencies. Today, I want to speak about the key considerations a custodian or an asset manager should have before selecting a technology vendor. So it's mostly agnostic of our technology solution. I don't believe that there is one size fits all when it comes to technology for cryptocurrencies. Depending on your use case, the best solution will vary. And I just want to highlight what could be the key question you would need to ask yourself before selecting either a partner or deciding to build a solution in-house. So moving on, let's start by looking at the business considerations. And this is basically an aggregate from discussion we had with our own customer, prospects, and the market. So the first, the business is really, really important. A lot of institutions are approaching this problem from the technology angle. Technology is important, but business should be put at the center. For instance, one of the first decisions that you will need to make is, are you going to manage segregated wallets or omnibus accounts? So depending on the regulation, you might not have a choice. But if you have to operate segregated wallets, it means that, for instance, you will not be able to do transaction batching on Bitcoin. So your transaction fees will be 5 times higher. So if you have an institutional customer base, it will have a very little impact because they do large value transfers, and the network fees of the blockchain are very small compared to the transfer size. If you're going to address smaller customers in terms of asset value, these network fees will add up. Another question you want to ask yourself is what will be your transaction volume? And I'm not speaking into total amount, but in number of transactions, because depending on your transaction volumes, a different solution might be relevant. And it really depends on also on your willingness to automate everything or to have manual check in the transaction process. If you automate too much, you might introduce too much operational risk in your platform. If you don't automate enough, you might have a competitive risk because it will be hard for you to comply with the SLAs when you have a bull run on the market and a lot of people are trying to make transfers from your platform. I want to illustrate with a concrete case. As you know, if you have a hardware wallet, doing a transaction is fairly simple. You plug in your hardware wallet and you create the transaction on your platform, and then you approve it on your device and it's sent. We spoke about multi-approvals, multiple people having to approve a transaction, and having such a process can make operations sometimes complicated. So I'll take the example of doing an Ethereum transaction, which is the illustrated here in the middle of my slide. When you do a transaction on the Ethereum blockchain, you need the nonce of the previous transaction in order to send a new one. And if you're working with a solution, for example, MPC, what you're going to authorize is the raw transaction, the one containing the inputs of the blockchain. So it means that if you have 3 transactions to make, you need to do the first one, have it fully approved and sent to the blockchain. Then you can start the second one. So you have your transaction which are going to be really sequential. So if you have a lot of transactions to make and it's a manual process, it can take a very long time. If you're taking a different approach like we do with hardware security module, what you're going to approve is not the raw transaction. It's actually a request for a transaction to a specific beneficiary with a specific amount. And since it's only a request and not the raw transaction, you don't have to think about the dependencies between these transactions. The platform will manage it for you. So it can make the difference of doing 3 transactions in 20 minutes or 2 minutes. And that's a major change and that's only possible if you use something which works in this paradigm of first approved, first signed, instead of first created, first signed. That's really a specific example. Another example, and there, of course, I'm cherry picking an extreme example. If you decide to opt for multi-sig on blockchain, for example, if you would have decided to use multi-sig smart contracts on Ethereum, you could have leveraged it for a couple of years without too much issue. But with the DeFi craze, we've seen the network getting more and more busy. Creating a wallet could cost up to $20 to $30, depending on the price of Ethereum and the business of the network, while on an HSM or MPC for the matter, creating an account would be free. Sending a transaction, 5 times more expensive than a normal transaction in terms of network fees. And creating an address would also be something that you have to pay for, while it's free on solutions which do not do this directly on the blockchain. So again, depending on the size of your customers, these fees can add up. If you need to subsidize every wallet up to $30 before your customer does anything, if your customer size doesn't allow to absorb this, because basically they don't have so much value, if you're looking more towards the retail space, this might not be the right solution for you. Going back to the operational concerns, you need to think about what will be your business hours, your transactional SLAs, and will your solution enable you to work remotely? If you have a solution which is tied to a physical location, we spoke about, Adrian spoke about cold storage, where things were really related to physical locations, you might have a problem in the case of a pandemic. So we could see for ourselves at Ledger that two years ago, being able to access the vault remotely wasn't that important in some cases. And we were really surprised by that. And there the mindset completely changed, of course, during this last year, where our customers are asking their operators to be able to interact with the platform securely from their home. So you really need to take that into account. And even before speaking about the technology, you need to think out how you can address these specific challenges. Last but not least, depending on your use case, you either want a solution for yourself or you want a solution which will enable to expose a service to your own customers. And when it comes to extending this service to your end customer, how do you make sure that this leg, this exchange of information is secure as well? We have an answer at Ledger, but what we've seen from the market is that in order to take withdrawal requests, for instance, it's used to start with phone and video calls, sometimes fax, sometimes WhatsApp, a lot of solutions which are completely out of bound of the solution, the crypto vault solution. There are also phone applications. Sometimes they make usage of a secure enclave of the phone, sometimes not. There are two-factor mechanisms as well, Google Authenticator, SMS-based, YubiKeys. And we believe that the gold standard is really made for purpose dedicated hardware. So at Ledger, each user operating on the Ledger Vault platform gets a device, which is a small tablet, which contains his identity and which enable them to validate on their device that this is the operation that they want to do. This secure device communicates through a secure channel to the hardware security module. So you really have security end-to-end, and you can distribute these devices to your own customers if you're a custodian. So you really secure the overall relationship with your platform. Now, moving on to the technical aspects. So how would you go about having a solution from a technology angle? Would it be best to buy or to build? I don't have the solution for you out of the box. It depends on your use case, but there are things I can tell you you need to think about, because we had to think about it while we were building our platform. So in terms of day-to-day, how frequent will the updates be? And that will also depend on how many cryptocurrencies you will support. So for the last 2 years, we have released a new version of the platform every month. It's a SaaS platform, so it's very easy for our customers to basically follow, because we do everything on their behalf. But will you be able to update as frequently? Also, knowing that unlike other solution outside of the cryptocurrencies market, your update timeline might not be in your control. For instance, over the weekend, you might have seen on Twitter all the noise around Ethereum and some service providers of Explorers being down because there was a change at protocol level, which was miscommunicated to the key suppliers. So basically the whole Ethereum ecosystem is to a certain extent for some a bit centralized because it relies on a couple of critical providers. But these providers, they need to follow very actively what happens for each and every cryptocurrencies. It's a huge challenge. It also means that you need to change your planning very quickly and have the relevant competitive intelligence on all this blockchain in order to react quickly. Are you ready to operate 24/7? These are not traditional financial markets. It's not 8/5 or 24/5. It's 24/7. So you need to change your organization in order to achieve that, and it requires some scale. Before even thinking about maintenance, will you build your own infrastructure? So have you looked at the price of hosting nodes, hosting explorers, caging for your secure hardware? Have you looked at just basically that cost without the human cost? And have you made the computation? How much would it be in your country or in distributed geographical location? Can you maintain the technical knowledge for over 20 cryptocurrencies? Having the knowledge for 20 cryptocurrencies 3 years ago, it was not so complicated. Now the top 20 is increasingly different. There are less and less copycats of Bitcoin. The top 20, they all have original cryptography, different mechanisms, and so on. So it's getting more and more complicated to support the top 20. Supporting Bitcoin and basic function of Bitcoin, it's easy. If it's the only thing you want to do, probably that almost all solutions do it. But not when you go outside of the top 1, top 2, what is available open source, is less stable, is less reliable, and you really want to have people with deep expertise in order to help you. How many suppliers will you be dependent on? There are a lot of suppliers for the different building blocks of a crypto vault. Will you be ready to manage all these suppliers, knowing that your SLA will depend on their SLAs, and you need to take all these factors into account? And last but not least, how advanced is your security team? And will you get certified? So building a solution is the first step, but having a stamp of approval from third parties in order to get insurance, in order to reassure your own customers is as important. This is complex because there is a lot of education going on when you undertake that journey. And also it takes quite a bit of time in order to have a third-party evaluation like common criteria on your platform. So just in order to conclude, really, I wanted to highlight that there are a lot of details about each cryptocurrency, crypto vault solution. Each solution, each technology will have its pros and cons, and there is no one size fits all. But it's very important that you make the right choice, because your custody solution will be the foundation of your other activities. Like Markus highlighted it, custody is not an end in itself. You need to be able to provide value-added services on top of your custody offering, and making sure that you've identified all the use cases which are relevant to you now and in the future will make the difference. I think, and obviously I'm biased as a technology vendor, that today the market has, and related to the question, the market for institutional is still relatively small. We're speaking about maybe up to 50 billion in cryptocurrencies in the institutional space. So as I mentioned, a couple of points where you need
maybe
to be
try
careful.
to conclude in 1 minute, because we're a bit
20 seconds.
Okay.
20 seconds. I think it's very important that you think about the economies of scales in your solution, and buying a solution might be your way to really enter the market and hit the ground running very quickly. That's it.
Thank you, Vincent. So sorry for the small interruption, but I want to keep it on time. I have a question for you from the audience regarding you talk about the low fees, and someone was wondering whether, regarding low fees and the compliant stable Bitcoin, why do we only see a Bitcoin Swiss supporting the BSV? And are we having a Swiss neutral approach on this regard? Are we being kind of neutral, or is it a good environment to develop?
So I can only speak for ourselves, and we are not Swiss, we are a French company, but I can say that for us, every time we want to evaluate the support of a coin, we look at different criteria. Of course, the relative size in terms of market cap. Is it worth it for us to spend the time? But also security mechanism in the cryptocurrency. Here, the lack of some security mechanism is the reason why we decided to not support BSV. Okay.
Thank you a lot. Thanks a lot. You'll have the chance to all debate about what's being said. I'm happy to hand the floor to Tina, and Tina will present the legal aspects. And it appears that we have many questions in this regard. So Tina, the floor is yours.
Thank you very much, Gabriel. So hello, everyone. My name is Tina Balzli. I'm a partner at PwC, heading the legal, banking, fintech, and blockchain operations. So next few minutes, it's about regulatory environment around custody of crypto assets. So the first thing, which of course comes to our mind, you all know that next year, supposedly already on the 1st of August, we're going to have our own kind of Swiss DLT legislation. Special thing about that legislation is that it's not like a one-off statutory act. It's actually an act changing other laws. And as such, I'd like to point out here in the context of crypto custody, one major change to the law, which concerns the clarification of segregation of crypto-based assets in the event of a bankruptcy of the custodian. So which is, of course, a vital question when it comes to the security of your assets when having them with a custodian. So the new act proposes a change both in the bankruptcy law, the Swiss bankruptcy law on the one hand, and in the banking law on the other hand. And these two amendments are in parallel. So what do they basically say? They both do not differentiate between the types of digital assets tokens, which are effectively in custody. So it is irrelevant whether the token qualifies as a payment token, as a utility, or even security token. The decisive factor is how the private keys are effectively being stored, custodied. It's relevant whether the assets can individually be allocated to the client, to the third party. That's the only relevant factor. Again, not whether in particular it's a payment token or a security type of token, which effectively is still one of the major drivers for today's legislation. But that's not going to be the case going forward. So what does this effectively mean that pursuant to the new legislation, it's decisive whether the asset can be individually allocated to the third party? Now, unlike today, this regulation does not require that the asset is individualized on-chain. That's the significant change here. Under the new law, it's sufficient if the segregation is off-chain. And what does that mean as a consequence? It means that under the new law, on-chain pooling of the digital assets is possible without, as a consequence, losing the right for segregation in the event of bankruptcy, and at the same time also without necessarily needing to obtain a banking license. So what is then sufficient effectively from a legal perspective under the new type of law? For segregation purposes, it's actually sufficient if the custodian has like an internal register at hand. Current law and also the ordinances effectively, which are currently in consultation, they don't specify how this register is supposed to look like. So one can take the rather bold position that even an Excel table would effectively be sufficient. Now, what we need to understand here is that there are two sides of it. The same changes are being made in the bankruptcy law, but at the same time also in the banking law. Now, since that the technical specifications have not yet been put out, it will effectively be both the bankruptcy authorities on the one hand and the regulator, the Swiss Financial Market Supervisory Authority on the other hand, which are going to come up with their practice on what effectively will be sufficient in terms of internal register of the custodian to have that segregation validly put into place. And at least if we're looking at the banking and the FINMA side of things, it is nevertheless quite unlikely that FINMA will be accepting a simple Excel which is manually upheld in order to have the effect of a segregation. Why is that? Because it's not only the FINMA which is going to be decisive in this play, it's actually also the auditors which are going to have a say in stake. And auditors like to have assurance in what they are effectively reviewing. So the type of register will need to be auditable and reliable also for the sake of auditors. So currently we don't really know what will be the best practice going forward for this type of internal register, given that on-chain segregation will not be needed anymore, which of course is the major advantage of the Swiss legislation here, apart from the fact that the Swiss legislation gives security to both the institutions and also us then as clients in when exactly our assets will effectively be taken out of the bankruptcy estate should the worst possible event, bankruptcy, come into place. Thank you. Happy to answer any upcoming questions.
Thank you, Tina, for this presentation. I think the legal questions are always somehow in the heart of all the discussion we have, especially with regard to crypto and as it's a very fast evolving world. I have one question for you from Christoph Ebel. He asked this earlier, but I wanted to ask it now. You talk about the AML regulation with regard to the custodies and the crypto custodies also very briefly, and I was wondering what was exactly the criteria that is today the one that will be looked at to know whether or not you are a financial intermediary, especially when we look at the ordinance. For instance, it would be interesting to have your vision on the ordinance that is currently under consultation, where it's one of the rare time where we have seen a Swiss legislator talking about multi-signature wallets. I think it's it's quite noticeable, and I wanted to ask you this question from Christoph Ebel, but I believe the question really relates to when do I qualify as a financial intermediary? So that would be my question.
So exactly. So just to let you know, the changes which are probably coming up in the AML space, they are not now directly connected to the new DLT legislation. DLT legislation has very limited impact, in particular in the area of trading facilities with regard to AML questions. So it's a kind of a separate working stream of the regulator. Now, generally, the notion in Swiss law of financial intermediary is quite broad. So anyone who helps to custody, transact, manage assets of others is basically already a financial intermediary. So basically, if you're involved in custody, and especially if you really qualify as custodian in the legal sense, in that you are really managing and have access to the private keys, then basically you are already in scope. As also with these new types of regulations regarding the Bankruptcy and the Banking Law Act, it basically applies also the segregation right, and there where it's also then relevant for the question whether you are deemed to be a financial intermediary or not. It depends on whether the custodian has direct access and can transact more or less than on its own, or at least in connection with the client or not, with regard to the digital assets. If that's not the case, if the custodian does not have access to the keys, is basically just a provider of a solution in terms of IT and in terms of app provider, then he is basically not deemed to be financial intermediary either. So it is still quite clear in terms of law, and the kind of differentiation is not being changed that much in that sense.
Thank you very much. I'll now let Amy Lawrence take the lead, and I thank you all for your presentation. I also like to thank Nikki. Now you have the floor, Amy, for the part with regard to the panel. Thank you.
Thanks so much, Gabriel, and hi everyone. My name is Emmy, and a shout out to the Western chapter, because the Western chapter put this event together, and I'm on the board of the CVA. I'm not going to take too much time with introduction. We are going to transition now to the panel, and I do see all of you, so that's great. This panel is going to be about the evolution of the crypto vault, because how 2 years ago a vault was functioning and what requirements it was fulfilling, it has evolved since, and there are so many new requirements for a crypto vault. So to warm up, maybe just a few thoughts that, as you said, Markus, we have seen an influx of volume coming into crypto, and finally traditional investors are realizing that cryptocurrencies are a vehicle of great potential, and they are not only outperforming traditional banking products, but they bring this greater efficiency and transparency as well. And it's important that the custody element for digital assets also comes with greater efficiency, and it's even better than what we have in traditional banking. So to warm up, my first question is going to go to Markus and Adrian. And basically, what is your experience when you talk to a traditional type of players? That what is the most challenging thing? What they ask or what they lack to understand? So basically, how this transition can be smoothened.
Markus, I will start with maybe the first part of the answer, which is if we consider today crypto native companies, like some of the exchanges that have come on the market a long time ago, or actually even companies like Bitcoin Swiss to some degree, they could build their whole infrastructure in reinventing everything from scratch. And what I mean by this is that there was no constraint of habits, of internal processes, and many of the mistakes that had been implemented by banks in the past have been re-implemented in some of the native companies that have been active in the last 10 years. And this is what has led to kind of lack of professionalism or fraud or issues with exchanges or custodians that discovered their activity and the magnitude of the task, of the challenge, as they were already operating in production. And I would even argue that several of the banks that do offer crypto custody or crypto services today have started with very simple solutions. And this is a shout out to Ledger. I know a few companies that actually custody their crypto assets on Ledger Nano S. So really USB sticks, which are obviously secure to some degree, but they've not been designed for institutional use cases. And what we see now more lately is for adoption in banking, we now have a requirement to provide solutions which can perfectly align with the traditional processes that banks are subject to and have been going through in the last an option. In fact, banks want to deal with cryptocurrencies or with digital asset use cases the exact same way they interact with traditional assets. And the capability to provide and workflows, to provide control and risks processes that look the same and can fully integrate into their core banking systems is now what is the most valuable for larger banks and more professional banks getting involved in this field.
When we speak to institutional clients or potential clients who'd like to start coming into the crypto space, they're obviously very concerned about how to properly build their infrastructure around crypto vault and brokerage and liquidity. They're concerned about Forex, about FINMA, about FATF and AML. They feel they need to build their own vault. And we tell them, keep it simple. Just get going. They can just onboard to Bitcoin Swiss and we take care of everything with our brokerage and fully audited custody services, including, as you say, Adrien, with the onboarding and integration into Avalok and other core banking systems. We've been operating securely since 2013 and support the broadest range of coins and tokens, more than 150 different assets available to buy, sell, and hold through Bitcoin Swiss.
Thank you so much, Adrian. Thanks, Markus. So the next question goes to Vincent. And in your presentation, you outlined a scenario of buy versus build or build. And when it comes to resources, when it comes to know-how, and when it comes to cost, then to me, it seems pretty much like a no-brainer that you're better off rather buying a crypto wallet as opposed to building it.
Yeah, so I think the bar to enter the crypto market as a custodian has kept increasing in the past 3 years. 3 years ago, it was still acceptable to enter the market, saying that you secure Bitcoins, they're in a cold storage, they don't move, and that's it. Now, a lot of vendors like ourselves have been working very actively and for the past 3 years, and they have built an organization in order to grow this solution and basically enable this financial institution to leverage infrastructures and solutions which are distributed across multiple solutions, which benefits economies of scales. So I don't think it's a clear-cut scenario. If you're a very, very big tier 1 bank, you might want to go ahead and build this solution in-house. But we also observe that on this market, some actors which decided to do that without asking themselves the question, is it complicated? Will I find the talent? Will I find the know-how? Who can help me? We see that these institutions, they fail to deliver. They are not into market or they don't have a solution that they expose externally. I think that while this market mature and while this market scale, it's obviously a great choice to start by buying a solution and benefiting from what already exists and focus on building added value services that you can build as a financial solution on top of a custody platform. Because the technology providers are not financial institutions. They don't compete with you on, for instance, lending. What they do is they enable you to build added value services. And I think that's where the crypto custodians of tomorrow should focus.
Thank you very much, Vincent. The next question is for Tina. Thank you for your presentation earlier. And basically, the European Securities and Markets Authority has not defined yet the safekeeping of crypto assets. In Switzerland, we are, as usual, ahead of the game. And with the blockchain law, we have a clear vision on how to regulate custody. Now, how do you see the impact on the field of the blockchain law, and also PwC Switzerland can help institutions who want to custody digital assets, and how you do that?
Mm-hmm. So thank you very much, Emmy. First part of the question regarding, well, what does it mean that Switzerland is now ahead of the game, actually, in terms of clearly stating how the asset should be treated, for instance, in the event of bankruptcy of a custodian. Now, the thing is, yes, that's an advantage. It gives legal security. Everyone wants to know what happens in the worst case. And so Switzerland will, of course, become even more attractive also as a custodian in the digital asset space. However, having said that, that's, let's say, part of the picture, because even if you are a Swiss institution and you have your rules and regulations in place, obviously for Switzerland, you have security on how this will be treated. This will, of course, also apply to any kind of clients which are based abroad. But the question is, are you allowed to offer your services in these foreign locations or not? And if so, on which terms? And that is not so much a question of Swiss law, that is to be answered and to be looked into by the foreign legislations. Is it at all possible, for instance, to offer this kind of crypto custody on a cross-border basis? Or is it rather also treated from the foreign law perspective as a banking service, which needs to be regulated or cannot even be offered on this cross-border basis under certain circumstances? So yes, the change in law in Switzerland is certainly an advantage, puts the Swiss financial market into a preferable position, but it will also depend on how this kind of service is deemed abroad and whether it can be offered and on which terms to clients abroad. Second part of the questions, well, how do we assist institutions in the market? We assist institutions in the market in assessing their custodian setup, how this will be treated from a regulatory legal perspective here in Switzerland. It goes far beyond just this type of assessment. We also assist on technical parts, on assurance parts, in auditing in a non-financial way, the setup, and giving assurance also with regard to the setup. So a broad perspective and offer of services in the crypto custody space. Thank you.
Thanks so much, Tina. I think that's so important because basically in custody or custody infrastructure, you just have so many companies offering their services. So definitely you need some guidance because otherwise you can just get lost quickly. I would have loved to take a question from the audience, but there is no question as of now. So I would like to encourage all who are listening to throw in the questions into the chat. So the next question is addressed to Markus, Adrian, and Vincent. And this is basically what I mentioned at the beginning, that the role of the vault is so different today than it was 2 or 3 years ago. So I'm curious how you see this. Markus, maybe you would like to start?
Let me start with the product view. And the crypto vault is at the heart of the core banking system of the future, the core banking system of the decentralized world. That's how we look at it. And its role is to keep assets safe and enable money to work. So it's the smart vault that allows our clients and everybody to participate in on-chain financial transactions, such as staking, DeFi, and governance.
When taking on this, I would say the big difference is, I mentioned it already, but it's no longer about storing. Metaco is positioned slightly differently than Bitcoin Swiss is. We are a technology provider. We support banks with a SaaS offering or an on-prem offering so that they are self-custodians themselves. They are in control of their keys and they don't have to rely on a third party to manage their keys. It is obviously a trade-off. It's always the same thing. It's different to work with a company like Bitcoin Swiss than it is to work with us. But we provide the whole infrastructure for banks to now start using these coins and investing and tokenizing. And we think really that the trend is now moving in this direction. We see strong demand for cryptocurrencies, but also now for the new use cases related to staking and decentralized finance.
So I agree with both Markus and Adrian. I really think that your crypto vault will be at the center and will need to communicate with many other services. There are demands for clearing offering, for better liquidity management solution. Your crypto vault needs to be able to interact with a solution to generate yield. Also, we see more and more demand for layer 2 support, which could make blockchains more efficient. Tokenization, like Adrian mentioned, is a very important use case. And as well, there are some support or compliance services which basically need to communicate with your crypto vault, such as KYT providers, enabling you to have a good view on the origin of your assets.
Thank you very much for all three of you. Then the next question is to Tina, and I'm curious to learn that. What is your biggest learning as a lawyer in the crypto space around the crypto vault?
Thank you, Emmy. Well, it's as always with lawyering, and actually it has been confirmed that the standard answer of a lawyer that it depends is just as valid here as elsewhere. So having said that, I mean, we're talking about an emerging market. There are no technical standards out there yet. At least that is my take from a pure lawyering perspective. And that means that we have to look into every solution on a single case basis. And only when looking into the specifics of the single case, we can then assess from a legal, but also from operational and from assurance perspective, what effectively, how the solution effectively qualifies. So as always, we need to look at the detailed case and then assess on a single case basis. This will change eventually if kind of a single solution should become the standard. But until we're there, and hopefully we'll still have a lot of competitors on the market going forward, there will still be enough work also for us lawyers and other specialists. That's of course the good news.
Yeah, we certainly need you all, not a doubt. So before taking the questions from the audience, then I have a last question for each of you. And that is that, so entering the crypto custody field can seem like a very lucrative business. And what are the value adds of each of your companies? And maybe this is just in a few sentences, so the respective companies you're representing today. And then how do you see the future of the crypto vault evolving, if that was not covered yet in the two questions before? Who wants to start it?
Okay, I can start. So I think with the Ledger Vault, so is it a very lucrative business? I guess it depends. Like traditional custody, it's a game of scale. So it's about being able to support many customers, and there it's the amounts which come into play, because most of the models are based on fees, a percentage of your total AUMs. And what makes our solution different is that we are the experts in hardware security. We are the experts in the hardware retail space with the Legend and OS, where we sold over 2 million devices. And in the Vault space, we have built a unique solution with this combination of personal security device on one hand and hardware security module on the other hand, which can communicate very, very securely. So our model is simple. It's a SaaS. It's very easy for a financial institution to integrate it within its current operations. That's it.
I'll be happy to follow up on that one, because you said simple, and I did have my sales pitch earlier already, so I'm not going to repeat that. But we're very serious about keeping it simple. And for many of the institutional companies out there who are taking the first steps now, they don't have a very solid understanding of the strategy of why they do crypto or what should be the next step. And for them, it's really valuable to just do something and get going, to get their feet wet in the crypto world. And that is really easy to do with a full service provider that offers both audited custody and best execution brokerage. and who has experience with onboarding and getting other banks and crypto funds and proper funds into the crypto world. We are here as a pathfinder to help clients do a first step in crypto and decentralized finance. And we're more than happy if some of our clients go down the rabbit hole and become very serious about it and start building their own infrastructure and trading desks and everything. That's us spreading the word of decentralization and crypto financial services. That's what we're here for.
I mean, let's be clear with what's happening on the market today. I don't know of any bank that has got into cryptocurrencies that is today having an incredible business case with digital assets. I think this is a market that is becoming, that is also obviously going to be a massive part of the financial industry in the future. But today, for banks to invest is an out-of-the-money option. It is a highly leveraged investment in which they can get in to not miss out of something which is coming for sure. There is no way out, but which may still take a couple of years or maybe a bit more, that it becomes evident for every institution on the market. Where we position Metaco is as the entry point to that market. We have been now in Europe in general with some of the largest banks on the market that have made the move to get into digital assets. I'm not saying our clients make money. We are making maybe more money than they do. But what we know is that they have important commitment to that system, because they see what all of us see. I'm sure in this webinar, that this market is growing. Bitcoin is reaching again the 20K. Tokenization use cases are growing. DeFi is becoming more and more exciting. And what we see today happening with finance in 2 or 3 years from now is not just going to be the disruption of finance. It's going to be disruption of most of the contractual relationships. And I'm pretty sure nobody can opt out of such a revolution. So Metaco is the foundation for this, and we will continue pushing on all of the markets that we present in to guarantee that we are the enterprise reference for digital asset management.
So happy to conclude from our side. Fully agree, it's an emerging market still to date. So we as PwC, we see ourselves as guide through this emerging market, as independent guide, coming together from various angles. We have the technology knowledge internally, the audit knowledge, obviously, also the legal regulatory audit angle. So in terms of value proposition, we can cover any kind of question you as a market participant may have. And it is our biggest pleasure to help clients find their way through this kind of new developments, so that the best possible solution is at the outcome of things.
Fantastic. Thank you so much for all 4 of you. So we can take one question from the audience, and that is basically the CBDC one. Fabio Keller is asking, do we need CBDCs? And if yes, how many globally? I don't know if anyone is brave enough to answer this question, or is there an answer for this? But what is the impact on custody when it comes to CBDCs? Who's going to custodian all these central bank digital currencies?
So this is the topic that we know very well at Metaco. Several of our shareholders are some of the very famous central bank suppliers for cash and for cash management, printing. And what we see in the numbers we observe in our discussions with central banks is that today, 80% of central banks are doing research on CBDC, out of which half of them, so 40% of central banks, have now prototypes ongoing on how they could issue CBDC, and 10% of all central banks have concrete initiatives to launch a CBDC. So what happens, this is coming. And before COVID, before Libra and all other stablecoin initiatives, this was still some sort of long-term dream that potentially at some point, stablecoins could be issued by central banks and be part of the crypto economy. What we see today is that it's no longer a long-term game. This is something that could come in 3 to 5 years, even shorter for some of the central banks. What does it mean? Well, the big difference with a CBDC is that there is a direct relation between the central bank and the individual. You may be able to bypass the intermediaries in between, the commercial banks, the payment processors. This is a huge disruption of the payments networks, the way we see them today. And keep in mind that payment is still the number one or number two source of revenue for commercial banks on the market. So we see a new model where commercial banks don't have the choice. They have to adapt and they have to align with CBDC, and potentially they have to compete with not just Bitcoin Swiss and the other custodians on the market, but also Google, Facebook, and Apple, which come on the market as technology providers and suddenly become immediately compatible with something which has become more technological than financial. Obviously, we see Metaco as being a big player also on that field, both supporting central banks and commercial banks having to interact with CBDC.
Thank you, Adrian. Someone else has anything to add? Okay, thank you. So there is one other question, which I believe this is for you, Tina, and I want to be mindful of the time. So maybe if you want to take it, I'm happy to read it. So how can we help dealing with I don't know this word, obfuscation. I think there's a typo in there. So privacy features built in on different chains like Monero, Zcash, but also Schnorr or BTC and mixers. So how do we treat these chains in terms of cross-border compliance issues, CFA bans? Yes.
Okay. That will be a difficult one to answer briefly. Maybe you can send me afterwards the contact person. But generally, I mean, if we're talking about custody, if we're talking about payment services, it brings us back to AML requirements. So you need to know your client, where the funds originate from, and obviously these types of coins bring certainly don't enhance and make the process easier. So basically, they pose additional questions and burden on the custodians and the financial intermediaries transacting with them.
Thanks so much. That was actually
add here very briefly in the Crypto Valley Association's cybersecurity working group. We recognize the importance of privacy features in blockchains, and that's why we have started research into what are the different privacy techniques that exist at all the different levels, from smart contracts off-chain down into the core protocols of blockchains. And that would allow then banks and other regulated entities to properly choose which techniques and which blockchains to support with what measures to properly guarantee compliance to all legal and regulatory requirements. That is upcoming in about a couple months, so stay tuned for that publication.
If I may add just something about this, privacy coins are dealt with in the new ordinance with regard to the listing of those coins in multilateral trading facilities, and they are actually withdrawn from the possible coins that can be listed. So if you cannot make sure that the AML regulation is respected, your coin cannot be registered and listed on MTF according to the new Swiss legislation. But it's under consultation. Sorry, I just wanted to add this because I think
so glad that the lawyers here knew how to answer fantastically to that question. I would like to put my hands together to Tina, Vincent, Markus, and Adrian. This was a fantastic panel, and I will pass it on to you, Gabriel, for the closing words.
Thank you, Amy.
Yes. Thanks a lot. I would obviously like to thank the four speakers, but also Amy Lawrence and Nikki, Amy, my co-host, and Nikki, who does all the work, the design, and the marketing stuff for the Crypto Valley Association, and she does an amazing job. And it was a real pleasure to have you and to be able to make you discuss about those crypto vault issues. And I just wanted to say thanks, and but I have no ending sentence. So I would simply say that that it was great, and I hope that we can all see each other again and discuss about the future of the crypto vault and the blockchain ecosystem in Switzerland. So thank you guys, and have a great evening.
Thank you, Gabriel. Thank you, guys.
Thank you all. Have a good evening.
Thank you so much.
Bye.
Bye.